A coffee exporter in Brazil can sell beans to a company in South Korea and get paid in a currency belonging to neither country, the US dollar. That is like two people in Tokyo settling an argument by checking the rulebook from New York. Strange, until you realize nearly everyone has that same rulebook. The dollar sits on the side of 89% of all foreign exchange trades. Central banks keep roughly 57% of the disclosed foreign currency reserves in dollars, and this influence is much larger than America's share of the world economy. So the mystery is not why people call the dollar powerful, it is why the rest of the world still organizes so much of its financial life around another country's money, and what would have to happen for that to eventually change. The dollar did not win through a global popularity contest. Near the end of World War II, the United States had a huge economy, deep financial markets, and much of the world's gold. In 1944, 44 countries met in Bretton Woods, New Hampshire, and built a new monetary system. Other major currencies were tied to the dollar, while foreign governments could exchange dollars for gold at $35 an ounce. Think of gold as the foundation and the dollar as the house everyone agreed to use. Then in 1971, the United States stopped converting dollars into gold. You might expect the house to collapse when the foundation was removed, right? Except, it didn't. By then, the world already traded, borrowed, saved, and priced goods in dollars. The dollar had become useful because everyone else found it useful. Consider Costco. People join partly because Costco has lots of products, and suppliers want shelf space partly because Costco has lots of customers. Each side attracts the other. The dollar works the exact same way. A company in Mexico may quote prices in dollars because its suppliers accept dollars. Its bank offers dollar accounts because clients want them. Investors buy dollar bonds because those markets have lots of buyers and sellers. Central banks hold dollars because they can pay bills almost everywhere as well. And where do you park hundreds of billions of them? Usually not in a checking account. A major option is US Treasury securities, which is a gigantic market where money can generally move quickly even under stress. It is the financial equivalent of a multi-lane highway. Other currencies have highways too, but few combine them with same size, traffic, and number of exits. Here's the surprising part. America accounts for roughly 1/4 of global economic output, yet the dollar represents about 2/3 of international currency use across a broad Federal Reserve measure. The dollar is not nearly America's money, it is infrastructure. Owning the world's financial plumbing comes with benefits. Because foreign governments, banks, investors, all want dollar assets, demand for US debt is higher than it otherwise might be. That can reduce borrowing costs for the government, with effects that flow through markets to businesses and households. America also usually borrows from foreigners in its own currency. That sounds normal to an American, it is not normal everywhere else. Suppose a company earns pesos but owes $1 million. If the peso loses half its value, that debt effectively becomes twice as expensive in local money. An American company with dollar revenue and dollar debt does not face the same currency mismatch. There is also the shopping benefit. A strong dollar can make imported cars, electronics, clothes, and groceries cheaper. Your iPhone may say, designed in California, but its supply chain crosses multiple currencies. But here's where the free lunch gets a bill. That same dollar makes American products more expensive abroad. Great for a shopper buying imported coffee. Less great for a US factory trying to sell machinery in Brazil. Dollar dominance creates winners and losers, even inside the United States. For other countries, relying on dollars can feel like driving on a road where someone else controls the traffic lights. When the Federal Reserve raises interest rates to deal with US inflation, money may move toward dollar assets. The dollar can strengthen. Countries and companies with dollar debts may then face larger payments in their own currencies, and this is even though nothing changed in their factories. Dollar-based finance also gives the United States significant power to impose sanctions. Supporters see a way to pressure governments without military force. Critics see a reason to reduce dependence on a system one country heavily influences. So central banks have been diversifying. The dollar's share of disclosed foreign exchange reserves was above 70% around the turn of the century. In the first quarter of 2026, it was about 57%. But no single currency collected the missing share. The shift has spread across the euro, Canadian and Australian dollars, China's yuan, and other smaller currencies. Central banks have also shown more interest in gold. This looks less about one king taking the throne and more like the kingdom becoming a committee. If the dollar was losing ground, why not replace it with the euro or China's yuan? Because being a reserve currency is an awkward job application. The euro is widely trusted, but Europe does not offer one federal bond market on the scale of US Treasuries. China is a massive trading nation, but it keeps more controls over money moving across its borders. Reserve managers value moving large sums with few surprises. Gold avoids another government's promise, but it's clumsy for paying an import invoice. You will not settle a Starbucks order by shaving a tiny piece off a gold bar. Crypto and digital assets can move across borders, however its price swings can make a lot of tokens poor reserve assets. And the twist is that the largest stablecoins are mostly tied to the dollar. Digital technology that was supposed to route around traditional money may actually give the dollar a new set of rails. The biggest threat, then, may not just be one dramatic replacement. It may be a gradual fragmentation with more trade settled in local currencies, more central banks holding a wider mix, and new payment networks that reduce the need to touch dollars every single time. No one can give the dollar an expiration date. Reserve currencies fade more like an old shopping mall than a phone battery. One store leaves, then another. The building can remain important for decades because there's no better place to go. The current evidence points in two directions at once. The dollar's share of central bank reserves has declined over the long run, yet it still dominates currency trading, international borrowing, and crisis finance by a wide margin. Its future will depend less on slogans about the end of the dollar is near, and more on boring but powerful things, such as confidence in US institutions, inflation control, sustainable public finances, open markets, and whether a rival can offer something safer, deeper, and easier to use. So the most likely future is not dollar dominance forever, or its disappearance next Tuesday. It's a world where the dollar remains first, but being first matters a little less. Which part of that shift do you think would affect you the most? Higher borrowing costs, more expensive imports, or less US influence abroad? Put your answer in the comments below, and if you want one clear, useful breakdown of the biggest money stories delivered to you for free, join the Coyote Invest newsletter through the link below. Because if the dollar's power ultimately rests on trust, the next question is even bigger. Who creates that trust? And how can a handful of decisions at the Federal Reserve change the price of money almost everywhere? Thanks for watching, and I'll see you in the next one. Peace.